Good afternoon, everybody. How are we doing? Okay, so thanks very much for turning up, obviously, to Chem Outsourcing. I know that Mark Alessi has built this event on core attendance of not only the biotech community, but of course the pharma services, and we're privileged today to be able to talk to you about venture funding and what's going on in 2025. So I'm sure that you're all quite interested to hear about what's going on. We have two very esteemed guests here. We were going to have four, but we've got two. But I think we've got the best two. So we have a senior executive from the Oppenheimer Fund, which, as I'm sure you're aware, is a long-standing leader in market, which competes with some of the very large banks, but typically is more nimble and has been more adventurous with some of its funding. And we'll have one of their senior executives here talking about what's going on with Oppenheimer and obviously the markets that we have. Sitting next to him, it's a little bit of a tougher crowd. We have a senior executive from JP Morgan. So if you're going to pull on the two big boys, they're sitting here at the table. If you're not aware, my name is Nigel Walker, founder of That's Nice. We're a global marketing and research agency which has been servicing the market for the last 30 years. I think what we'll do first is do a quick introduction of each of us. I certainly can't present myself as well as these two gentlemen. Maybe we'll start off with Ron and knock yourself out.
Sure. Stefan Lauren. As was mentioned, I'm a managing director with Oppenheimer & Company, a New York firm, but we are global in footprint. I right now do mostly M&A and capital raises for biotech and diagnostic companies. I've been in the business, on this side of the business, I should say, since the 90s. I started life, I'm now considering myself a recovering chemist. I have a PhD in chemistry, worked at Abbott Laboratories, Scripps Research Institute, and have over the years served on multiple boards of directors of public and private companies as well.
Hey everyone, my name is Ankit Agarwal. I'm a senior vice president at JP Morgan. I largely cover biotech and large pharma clients, mostly focused on M&A advisory, IPOs, and follow-on activities. Really great to be speaking to you all today.
So I'm sure from the audience, a number of you have thought about why is the biotech market collapsed in the end of 2023 and the start of 2024? Well, there's a number of different drivers for that reason, and it's really got nothing to do with your mortgage rate. So I'm sure that you're understanding that debt is something that's a very important driver for obviously building early stage biotechs. And as there's obviously no revenue for many years, that debt or grants are very, very important to move it through early stages. So if you can consider that the debt market collapsed around about a year and a half ago, and you're seeing some biotech investments coming in at sometimes 15 to 18% to be able to drive those clinical trials. So if you get an understanding of the market, why is that the case, where you can see the prime rate at about 7%, and if you do prime plus 3 or prime plus 4, that's a typical debt. So maybe the first question out is to the panel, why is the debt market so weak right now, and when do you feel we're going to see a turnaround and that lower rate come in play? And that's obviously going to be a main driver for new initiation funding for early stage biotechs.
So I'll start off. I would say, tainted. I was a money manager for many years, both long only and hedge fund assets. So I did a lot of shorting in my times. And the first advice I'd like to give, and I should preface this by saying I don't work with large companies. I work with smaller companies, 2 billion, well, typically 4 billion and below now, because things have gone up a little bit. But I tell my clients, don't take debt. Use equity. People all talk about dilution, but in this kind of market, there's two types of choices. You can have dilution or you can go extinct. And that's just the way it works at this point. The reason why is these are very risky companies. And the risk premium, the extra amount that people have to pay to have the market absorb risk, has gone up dramatically over the years. So on a debt basis, that's why the massive gap. It's not like they've got sales. If If you take a look, there's a lot of biotech companies out there. I showed a sort of slide this morning, I think somewhere around on the traded biotechs, somewhere around 996 in North America. Of those companies, the vast majority of them are very small. And the vast majority of them, honestly, what's their business? Their business is selling stock, not really producing drugs, because most of them will never get a drug. So, not to depress anybody, but at the end of the day, there's a lot of risk. And when the market goes risk off, it doesn't want to see risk, the gap in rates go up dramatically. And that's where we are right now. For those of you following the news today, if you take a look at Bloomberg, I had my Bloomberg terminal up a little earlier, it now looks like we're going to get a 0.5% rate cut, or 50-50, a little bit over 50-50 chance. That means the economy is worse than we expected, but guess what? Rate cuts mean risk on. So that means now this morning in my talk, I hadn't seen this yet, I said I'm thinking most likely a quarter point. We need a 0.5 point to get the biotech market working again. At this point, I think that's some good news for us all.
So, Ankit.
Yeah, listen, on the same point, I think market might be pricing 100, 125 bips of rate cuts at this point, which in my personal opinion might be a little bit too aggressive. I think it's going to be 25 bips in the next meeting and maybe a little bit more down the line. Listen, for cash burning biotech, it's a good thing that rate cuts are going to happen, right? But instead of focusing on how much or how quickly, I think what's going to be potentially important is the messaging that the Fed has to the street, right? So long as they can avoid surprises, either on the positive or on the negative side, I think that's going to be helping the overall biotech ecosystem down the line.
So I'm sure that everybody in the room today is wondering when they sign a new contract, whether that be with a emerging, virtual, or small pharma company, what percentage of that business is actually going to be fulfilled from the contract that you signed. I'm sure that all of us have signed off on the 200 batches, and ultimately the order comes in at 20 batches, and they've signed you up and they've priced you at the 200 batch number. There's actually a little bit of a fact here, I'm going to pull from JP Morgan that we pulled off, is that venture investment into therapeutics totaled $17 billion across 350 rounds in 2023. That was a piece of data that was pulled from your end of year report.
Okay.
That we recanted there. So if you take a look at going back to those orders, and let's try to talk to the bankers here and get a real understanding of what that means, is that what percentage of deals that are actually coming into a CDMO are actually getting fulfilled? So you've signed an order, you've signed a contract, you've maybe even potentially done an MSA, but what actually percentage of those deals are actually getting fulfilled? And more specifically, how is that getting affected in the marketplace? Now, I know we're going into a little bit of more CDMO, CMC speaking here in contract deals, but how do we see those biotechs reneging on orders? And more specifically, you know, as you're doing your pipeline, a weighted pipeline, how much is that actually affecting the CDMO? So I'll partially answer a little bit maybe after yourselves, but maybe, Ankit, that might be a good one for you to maybe start off with.
I think you guys should go ahead. I don't focus on CDMOs as much, so you might be more.
So it's actually not just a single question. It depends on the area that you're in. The probability of success varies by area and varies by mechanism, it varies by drug. And understanding that in planning as a CDMO is a tough thing, but at the same time, it's perfect if you know portfolio analysis. So everybody, you know, for all those crazy guys getting laid off on Wall Street right now, you've got a great place at the CDMO helping you with portfolio math. From that standpoint, though, there are different areas. If you're focused on neuroscience, you're going to have an incredibly high failure rate. Okay? If you're focused on antibacterials, which is an area where investment doesn't like to go, it's a high success rate. So there's a dichotomy there, and the difference is 30-40% success difference. Also varies by phase, right? The earlier one is, the less likely you are to get all the way through. But if you're going into phase ones have, you know, for most areas, about a 50% chance of success. That's pretty good. Smaller order, though. So these are the types of portfolio decisions that you have to make, and it's different for everything. But on average, I would say that success rates are starting to go up. So that's the good news. Again, I hate to bring up the buzzword, but we are finding that the AI models are getting better, and machine learning is what we used to call it when I was in science. But they're getting better, and they're finding better ways to target clinical trials as well. Biomarkers are getting better. All of these are leading to better success rates, which is great news for CDMOs, period. It means more drugs actually getting through. The bad news is many of your clients will be bankrupted within 2 to 3 years. So that's the other thing you have to forecast. I was mentioning earlier, we have a lot of companies. We have too many companies out there. That's one of the issues. As that happens and we finally come back to a nice equilibrium where we have starts and failures, a few more starts and failures rather than many more starts than failures, and I think we're going to be in good shape.
So I can also help you a little bit from understanding, say weighted and underweighted market portfolios. So when we talk to the venture capital companies, the number one request right now is, do you have anything in derm? Derm seems to be very, very popular, and that's typically a very good driver with regards to R&D. And if the VC companies are looking to invest in derm, then derm is typically a good area for you to look to for CDMOs. The ADC market is obviously explosive, but we have some really major challenges there. The core of an ADC is typically built, obviously, as you know, from the 4 components, so chemistry, biology, the linker, and the bioconjugation. From the last 4 years of tracking the ADC market, we've seen that the majority of the drive of the ADC is built from chemistry. So you're at a chemistry show today. I think there's about 8 or 9 companies that are at this event that are really driving and trying to strive towards a complete solution for ADCs. Other than obviously the peptide space, which we obviously know has been very exciting since Novo and Lilly have had their authorizations, I believe that the ADC space will be the true frontier for oncology over the next decade or even 2 decades. Maybe our colleagues, do you have any thoughts on the ADC market? It's a very fertile space and typically brings stars in people's eyes when they talk about it, especially if you are focused on that business.
So I've got a request for our AV for a second. Any possibility I can get my slides put up from this morning on slide 42 so we can go through a little bit of this? Might be a little bit helpful for those of you that love eye charts. You're going to love the slide. But otherwise, yeah, the ADC area is hot. That's what we get back from people very frequently. And if we carried out a survey recently of venture investors and actually public investors as well, we do it every year. This was carried out in June. We closed it up at the end of June. So slide 42. Just rip through them as fast as you can to 42. There you go. And as we ask the question, what areas do you want to see investing in? Do you think are going to be hot? The blue bars are what they want to see. The red bars are what they don't want to see. You can see there's a number one request in mode of action was for ADCs. So it's very, very important you mentioned that. And at the end of the day, where the investment dollars go, that's going to be where the growth is for the next couple of years. People change their minds in the investment community, so that's the caveat here. But right now, this is where people are going and want to see over the next year to go. That's what they're planning. And then it's interesting, the folks we followed up with, we couldn't understand why anybody didn't want ADCs. The only comment that was negative was too many companies working in the space. So from that standpoint, we anticipate the market's not going to be hot, but get hotter, number one. And number two, the expansion into radiotherapeutics for ADCs creates a vast new market at this point as well. So I mentioned it this morning, we're very focused on radiotherapeutics, and that's been the lion's share of my deals for the last year or so. But from that standpoint, moving forward, we expect ADCs to take up more and more market share there. So that's a big opportunity.
Maybe we can talk a little bit about some of the pricing there for ADCs and radiopharmaceuticals. So at the end of 2023, we had a deal come across our desk for a company called Nucleus Radiopharmaceuticals. and I was quite surprised at the 65x that was requested on the deal structure for Q4 2023. That reminds me of Q1 2020 when we were exiting out of our cell therapy portfolio. From the macro banking side, we're trying to get some Ankit answers in here because he's holding the big name, so we've got to get him some voice. Are you looking at any of the large-scale mergers, or are you looking at any significant progress there for radiopharmaceuticals or ADC from the banking side?
Yeah, listen, maybe just talking broadly about the M&A landscape, right? We all know the problem here, 300 billion or so of revenue that's going to decline in the next decade, driven by patent cliffs. And most of these large pharmas have significant amount of cash that they can deploy to solve the problem, right? If you look at what's happening over the last, I want to say, 12, 18 months, I think second half 23 was pretty active. We saw pretty, sizable deals around 10 billion or so deal size. But if you look at the last year itself, we are seeing more of bolt-on activity versus, mega merger or even sizable deals, and that's really driven by the FTC overhang, right? The other thing that we have noticed is there's a scarcity of assets as well. Good biotech assets are pretty difficult to come by. The good ones are really expensive in the public markets right now. So folks are giving, they are looking at more private names, number one. Number two, they are also looking at earlier stage on the clinical spectrum, right? So for example, Novartis at the Mariana Oncology, that was preclinical, BI did a transaction as well in preclinical. This is above like 1 billion mark, right? So I think that's going to be something that we see typically in the next few months as well, is my expectation. On radiopharm, so I'm working with a couple of companies where we are thinking of IPO windows, let's say Q1 or Q2 of next year. And I think every IPO process at this point is a formal or an informal dual track where we're also talking to strategics, right? So I think a lot of activity remains to be seen on there.
I have a kickoff meeting with you this week.
Really?
Yeah. So there you go on the IPO side.
So from the audience perspective, when you're looking at, let's say, some isolation or maybe some new suites, looking at some cytotoxic compounds or radiopharma compounds, or obviously the high potent compounds, I think you all know is that the dollars and the margins are in the high 40s to high 50 percentile in that area of the business. But if we look at it from a banking perspective, the risk factors of going with a smaller CDMO on an ADC compound or a HP compound or a cytotoxic compound are still very, very high. So what we'll typically find that's nice is that a private equity company or a VC or even one of the large banks will call that's nice's research team and say, who do you recommend to go with? And there you have the big question, do we recommend one of our clients or do we recommend one of the companies that we think is best to deliver on the project? And the answer is always the second one. It's actually lost us business by doing that, but it's very important. From the research team at Oppenheimer and at JP Morgan, I have been on many of the presentations that your colleagues have presented, and it's always very strong. Do you find that sometimes that you have to, this is a loaded question by the way, do you find that you have to sometimes compromise some of your key business relationships to deliver core research honestly?
The answer is absolutely. I spent my early life actually as a research analyst before I became a money manager and now a banker. But from that standpoint, at the end of the day, not just from a moral standpoint, but from the fact is it's the law. You cannot talk your book, as we like to say. We very frequently have had issues at getting kicked off deals because we have been very honest. And that's just not on the banking side. It's happened because of the banking side. We got pulled off a deal because I felt a company had nothing proprietary after doing the due diligence and told them that. On the research side, we're frequently getting kicked off deals because we downgrade a stock. Our research analysts will downgrade a stock and just say there's something wrong here. or it's overvalued, don't take us. Well, guess what? When it's overvalued, that's when they raise the money. But the good news is that the bad news for us, less revenue. The good news is it's integrity, and integrity keeps us trading with the buy side, and it keeps us, out of our stripes, which is important.
It's the only way.
Yeah, I think there's a very strong Chinese wall between research and banking. The number of times I've lost a mandate because the research analyst did not like the company is more than a handful, right? And I think that's something that has to be honored, right? If the system has to work, so yeah.
I will say, as a banker now, my threshold is much lower for liking a company, to be honest, than a research analyst.
So maybe this is another interesting question with regards to when you're doing your due diligence, the CDMOs and the suppliers here in the audience. How many of you, again, maybe just a small raise of the hand, how many of you actually do any due diligence on whether your clients can afford to pay the contract that they've signed? Okay, maybe not everybody wants to raise their hand. Thank you, Susan, and a few of my friends here. But I know that it's less than 5% of our client base. We have a much smaller client base than my two colleagues here on the line. So one little bit of advice, and we'll have maybe three opinions, and maybe I'll end with the opinion, is we've got two gentlemen here that have done deals over their careers in the multiples of 10 billions. None of those deals are done without due diligence. Correct, guys?
Not only is that correct, due diligence for us, especially when we're dealing with companies like CDMOs, I used to do banking for CDMOs frequently, it includes walking the plants. It includes actually looking at manifest to see what's really happening, and at times showing up during third shift to make sure there's actually a third shift. So the answer is 100%, very extensive due diligence.
And as you'll finish this conference tomorrow and go back, and when that next deal comes in, hopefully on Friday morning for you, as Pfizer wants to order 100,000 batches, give that some serious thought. We find that the majority of our client base really struggles with understanding on how to say no to a customer. So this is really the next question for the panel. We've learned to say no because we didn't have any more capacity inside the staff, and we didn't want to open another office in another region. But we ultimately realized that the size of the organization was large enough. And that's a very, very difficult statement to make to your shareholders or your business partners. How big do we want to be? Let's talk to two prize companies that both have been around for Oppenheimer over 100?
Over 100 years.
Yeah, both companies over 100 years. How do you say no to a project when you actually know that it's a good fit, but you realize that you can't execute on it? Now, there's two companies here that really can pretty much execute on everything, but maybe it's an interesting question for earlier times in these guys' careers. We learned it by, first of all, taking a project on and failing, and now we don't fail. So how have you handled taking a project on, and whether that be from a finance or resources or a knowledge perspective?
We would always want to work with clients where we think we can add value, right? That's just the reality of it. The other reality is depending on the firm. So I worked at Credit Suisse for a couple of years and now at JP Morgan. Each bank or each organization has a different threshold of a minimum fee and kind of relationship or a wallet share that you would be aiming for, right? I think that is actually the biggest driver for bringing in new clients. I would love to work with clients where I think I can add value at a lower fee, but my firm would not allow me to. So I think that's how I think about relationships and like how to work for clients. But so long as you think you can add value, go for it. It's a motto.
We're a little bit different. Again, I focus on the middle market and below, so middle caps and below, where there's a lot of folks in my shop just like me, PhDs, PharmDs, other scientific expertise. We turn people down all the time because we just don't like the science and don't think it's going to work. So that's number one. And we're brutally honest. We will tell them that. It doesn't make us a lot of friends with those companies frequently, but we When we turn down, we're very specific as to why and what we think the problem is, and that's only after substantial due diligence and talking to them about what we think the problem is. So it's usually not a surprise by the end. For clients that we just don't think we can get the job done, meaning certain types of deals we don't like to do. There are banks out there who are different tier from us that serve a purpose. They will go out and they'll, I don't know if you've seen what are called warrant deals. They'll go out, raise $5 million for somebody, and at some point have 100% warrant coverage. That means not only do you give them a share, you give them a value like an option that gives them more value to the potential share buyers, or 200%, which is an extremely expensive deal. So from that standpoint, we don't play there. We don't do those types of deals for multiple reasons. We think they're harmful to shareholders, and if that's the only way to get things done, maybe that's not the right client for us. I think it's an image thing. And I'm going to be perfectly honest, as you look at the banking landscape, people, some of you may know this, some of you not, is that there are different echelons of banking, okay? So there's, up here you've got the JP Morgans of the world. We're a step down because, again, we're working with smaller companies, and I think I've only been on 2 deals on the top line with you guys in the last
Seems like one more
3 or 4 years.
right?
So hopefully, knock on wood, that it actually goes right now. But yes, we are orging up at least. So from that standpoint, it's a not just reputational, it's where we play. I mean, a lot of the deals I do are 30, 40, $50 million deals. I've done 100, 150, $200 million deals. We had a $600 million type of deal happen recently. But from that standpoint, that's the rarity. We're working in an area that the people up top don't necessarily want to play in. It's the same with the people below us. There's a place for everybody in the ecosystem. And that tends to be why we turn them down, either for science reason or because just the deal doesn't work. We don't mind taking on things that may fail as long as it's good science, it's a drug that we think is a high probability and a good investment for our clients. And the other side is, by the way, we also do some investments as well on our end. So.
I think the other side of this, exactly what you mentioned, right? So every bank or every organization has like a sweet spot. As you mentioned, we typically work on the larger transactions. As an example, that happened recently, I was trying to sell a company in obesity, phase 1 data, which was pretty good in our opinion. We went, did a wholesale side, didn't get a buyer. I think the next step for the company was to raise more funds and run a phase 2 trial, right? Get more data. I think that's not the sweet spot for JP Morgan, working with companies at that stage to raise capital, let's say 50, 75 million. And that's when we are upfront with the client, say, listen, we can do it, but you might be better served with another bank. So I think that's how the ecosystem is kind of built, right?
Yeah, so maybe what we can do is we can continue on that, because I know the audience sometimes is trying to get a better understanding of how financing is done in the biotech community. Stefan has an interesting slide, which is the historical biotech follow-ons. So if you get an understanding of what that means is when an investment is originally made into a fund or a biotech, and then what is typically the pattern of the follow-on investments that made by that maybe primary lead investment group or by a secondary group, and then also could be co-invested. So for the audience, obviously, as I know this is important to you guys, if you take a look at a relationship with a biotech, maybe you're signing up a $5 million initial contract, and that company has about $8 million in funding. For them to ultimately execute that $5 million contract with you, whether it be analytical work or IND, pre-IND material, or maybe even into clinical early stage for an orphan compound, there's a relatively low likelihood that that contract is going to get executed at a full $5 million, unless there's a follow-on investment. So as you look at your customers' progress and growth, you might want to spend a little bit of time each month, looking at the bank's data and seeing whether there is a follow-on fund happening. And I've spoken to a number of my friends here during today about that very subject. Maybe, Stefan, you can talk about that and how important it is to have that success with inside your contract.
So one thing I would recommend right away, that's a good point, is every one of your clients, you should have, if you have Bloomberg, great. Most people don't. Yahoo News, follow their news. look on it on a daily basis, have the pop-up. If they're raising money, that's great, then they can't cry poverty to you. Not a lot of companies these days have raised money, although this year is better than last year, there's no question. So the importance of getting to know your client here and getting to know when their data are coming. Again, sometimes there's communication that they're going to be publishing data at a certain place. They're telling the investors, you should have the same information flow as well. Look at the catalysts that are coming out. That's very important in terms of knowing your client, knowing the financing obviously is incredibly important. And as markets open up, quite frankly, it's an election year. That's a tough year usually. We can go through that as well a little later if you want to ask some questions about that. But, post the election year, we really think next year is going to be a good year for some of the smaller companies. But again, there's a whole band of companies sort of in the 20 million and below. I don't know what kind of future most of them are going to have. If they get data, great. If they get a little bit of money, great. Not likely to happen. But for larger companies, I definitely think that you really need to keep tabs and close tabs on them. And as the markets open up on the pipe side, which is a type of transaction, on the follow-on side in general, it's good news for everybody. But it has been a drought the last couple of years.
Yeah, listen, I think when we talk about biotech follow-on activity, right, as he mentioned, it's a little bit better than last year. You might have the numbers in front of you, but I think in biotech, we might have raised, I want to say, $15 to $18 billion year to date, which is neck to neck for the full year 23, right? So definitely going better. I think what's happening in most cases, for me, it is actually 100% of the cases, financing will always be following the data release, right? Most of the companies prep for financing in advance. They know when the data is going to be out. You guys know when the data is going to be out. And if the data is good, most of these companies need the cash and they will raise the cash. Even if a company is going to say, hey, we have cash runway till 2027, they're still going to raise capital, in my opinion, right? Because cash is king right now, and no one is going to take the risk of not raising capital when the opportunity presents itself, right? But generally speaking, it's a healthier environment versus what we saw last year. So long as you have a strong kind of a rational and strong story of use of proceeds, I think there's capital that is being deployed.
Year to date, there have been 12 IPOs. Last year, there were 13. All but 2 of the IPOs, by the way, are down since the IPO priced. That said, we're still at 12 versus 13. Historically, the median is about 49 if you count the go-go years of 2020 and 2021, where it was off the charts. We had, 99 in 2021, which was crazy, and that's what led to the market crash. So from that standpoint, but it is definitely turning around. We're seeing more. I can just tell you the lineup of our clients that want to do IPOs is just out the door, around the block. It's like going to, for those dates me, but waiting in line when I was a kid to see Star Wars.
Yeah, I think there are 4 biotech IPOs that are publicly on file, BioAge, MBX, Zenas, and Bicara, all looking at short-term windows before the election, right? I think how they kind of are executed and how they trade is going to be very important for the overall ecosystem. As I mentioned, it's healthier on the IPO side as well, right? A lot of folks are in the line ready to go public if they can. But the aftermarket performance is just not supporting it, the story, right? I think the median offer to current, which is the return that we have seen in the 2024 vintage, is like minus 20%. And to bring back the generalist investors that we saw in 2020, 2021 era, you need that to flip. Otherwise, it's going to be difficult to get that kind of demand back in.
The best way to say it is, anybody asks you, is the IPO window open? The answer is yes. It's just on the 32nd floor.
So, Stefan, you talked a little bit about the election there that's coming up on November 9th, I believe. I'm actually going to be voting for the first time myself as a new American citizen. Thank you very much. So, I'm not going to tell you who I'm voting for.
Please don't.
So, having been a retail investor myself, and in my company investment portfolio having 52 companies, much smaller portfolio fund than these two guys, but nevertheless, the majority of our investments are between 500,000 and 5 million. And ultimately that means that we're playing at a much smaller scale than JP Morgan and obviously Oppenheimer here. But what it is, it's also an activation for biotechs, and it's an activation for small CDMOs to be able to get to profitability, which is something that I think hopefully there's some people in the audience that really value. The question that comes into us is that, you know, how much money do we actually need to get to be profitable? And that's obviously a very open-ended question, like what car did you drive today to the conference? It's well, your car or your wife's car, or you didn't drive a car. It's obviously not a question that you can answer very simply. But there's a question that comes in very, very regularly to us, is most of our customers, which are, as I say, 60% CDMOs globally, is they really don't know how much money they need. Okay, and if I say to the audience, you say, well, where are you? How much do you need to grow your business, or how much do you need to get to profitability? It's a very difficult question. So on the banking side is when you're going out for funding, which obviously we're talking funding today, it's really important that you get some consultative advice on what you need to get to that next stage. When you go to an Oppenheimer or a JP Morgan on the larger scale and you're looking for funding, even though that's nice, not understanding that amount of money that you need is very damaging. So please go out and get some consultative advice on that. Is there anything you guys want to add on that? Because it does also realization of an IPO value. I think we all know the company Resilience, right? We all know Resilience, right? We had the pleasure of actually selling them their first facility, which was Therapure up in Mississauga. They went out to market right in the middle of COVID with a very lofty goal and tremendous board of directors. Probably Archie's board is probably one of the strongest boards in the entire world for a fund. I don't know if you guys disagree, but I know three Nobel laureates and a bunch of CEOs, very, very strong. But they were unable to position the business at the right size, at the right time, and they missed the market by about 3 months. That was about a $2 billion loss in opportunity, and it will probably take upwards of 4 to 6 years to get to that level, along with another $1 billion worth of investment. Now, those are some lofty numbers for chem outsourcing, great exhibitors, but it's exactly the same model, whether you're bringing a value of your company to 50 million, or with Oppenheimer at 600 million, or with JP Morgan at 10 billion. So guys, do you have some advice for our audience today on planning their finance and planning their presentation of what they need when they're going out to market? It's a difficult one.
So the answer is having a financial roadmap that's exceptionally detailed is very important. Not only showing what you need to profitability, and by the way, I don't understand that term. I'm a biotech investor, so right, profitability doesn't really mean anything, I think, to most investors. But from that standpoint, how you get there and what the roadmap looks like. Here are the catalysts that can create value along the way. We're starting a clinical trial. We're ending it. Here's our data that's going to come out. We're enrolling the next one. All that, and how much money you need to get to each stop along the way. This is one of my biggest frustrations in working with clients, is that we go in and we start asking these questions. And I'd say 80 to 90% are completely unprepared. And this includes some bigger private companies as well. On the public side, that's a little bit easier. Maybe it's 50% don't know what's going on. As you get up to the bigger echelons, the pharma companies, they know exactly what's happening. And the bigger biotechs, they've got great planning, so that's not an issue. But for companies that are going public, that roadmap is essential to have. Not just what's happening, but how you get there. And by the way, what we found out in our survey is that these investors are now not just concerned, even for preclinical companies, not just concerned with how you're getting to file with the FDA, they now want to talk to you about marketing and what your plans are. I know that's far in advance, but they want to see that there's a there there. Again, it's one of the greatest failures, I think, in healthcare right now is that you can't fund antibacterials and antifungals. So that's something that nobody's investing because they're looking out towards marketing. You can solve a problem, you can create a drug, you can have a high probability of getting approved, you just can't market it. So nobody goes and puts any money in the space.
We just started an AMR fund.
It's a long haul.
Listen, cash and how you're going to use it is the number one question we get from investors when we are marketing a deal, right? I've had a case for a public company last year where, let's say we went with 100 million ask. Investors forced us to raise 200 million instead because looking at the catalyst roadmap, like, hey, you need exactly 200 million to hit the next catalyst. I would rather give you that versus a lower amount. So I think it's super important to have a very detailed roadmap of exactly what you're going to achieve with the money that you raise from investors. And I think that helps you differentiate as a biotech company to these investors as well, because attention span we get from the good VC investors in the space is pretty minimal. So you have to be pretty buttoned up as a story before you kind of approach them.
So again, let's look at funding and growth and how do you actually achieve that. I think Stefan right at the start talked about trading equity right now, which is important rather than going bankrupt or going out of business. Debt right now is quite challenging. I think you've probably all find at some point as you started your businesses is that you maybe had to personally guarantee when you first started out. And the goal is obviously to move the business forward, and you've maybe forgotten that you still have that personal guarantee on your business. Now, if we have business owners in the room, you're probably now at that point where you couldn't possibly pay off your debt if you are in debt more than $10 million against your own personal assets. So there's an observation here on when do you actually move away from having debt, loans, to moving to an equity investment. And it's a question that I think a lot of people ask us on a weekly basis. Can I sell 20% of my company? Is it worth 10 million? Can I sell 49% of my company and still keep control of the business? So venture capital companies, by definition, and I've been investing for only 9 years. I think Stefan has that on the back of his hand with regards to time over me here. But get an understanding of when you are ready to take a venture partner on, which is really critical, and when you want to lose control. There's nothing wrong with losing control if losing control means you can double your investment and actually you can roll again in another 2 or 3 years from now. But it's a very important discussion. About 75% of our audience is guys, right? And we have a bit of a problem with this thing called ego. I started the company, I own the company, I want to keep control of the company. And then we have the fair sex of the audience here, maybe only about 10 or 15%, where there's a lot of understanding of what makes sense now at that time of your business. So if you are going to go into a funding round or you're going to extend your line of credit, get an understanding of where is your timeline and where is your horizons. Most of your contracts in chemical synthesis are 3 to 7 year contracts, which means is that you're in a place where you can really put value on the longevity of your relationships. And that in 2024 and in 2025 is going to be a decision that over 200 companies in the CDMO space will be making. Of roughly around about the 800 commercial CDMOs around the world, a quarter of them will be making changes in their financing. And that may affect your companies, it also may affect your position. Maybe our colleagues here, do you have an observation on when is the right time to move from a debt basis to an equity partnership, whether that be minority or majority? It's probably the number one question that we get from new customers.
Listen, when we work with clients, we tell them say no to debt. That's just the bottom line, actually, because I think that is something you start gaining towards, when you're a much bigger company, at least in the world that I work in, right? I wouldn't even think about dilution as a big problem in some ways. Like, I know no one likes dilution, but the reality is if you are in this ecosystem, at least in the biotech space, right, and you want to grow big, you want to aim to be a public company down the line, you need the VC backing, you need the right investors, because when we work with companies and we take them IPO right now, the number one thing that we focus on is insider participation. You need to build that base of investors that can contribute in further funding rounds, right? So I think that's how I think about with my clients on, debt versus equity. But nonetheless, there are some clients that I work with. This is like, for example, there's a company in the AI space where its valuation is $3-4 billion in the private markets. They are struggling with raising capital at that valuation, right? If they look at only equity. I think in situations like those, debt is something that you have to look for. I think that's a requirement, but again, like that's in priority order, that's something that's something when you cannot do equity, at least when you're thinking about going public. But
So,
views as well.
a couple other things is that when one brings in outside investment from a VC versus debt, you actually get their experience. And there are good VCs out there that understand operations. They understand what you do, what you need, and how to get you forward. So I'm not going to say it's free because they take an arm and a leg at the same time, but you do get real value, and that's important. We did a deal last year. I brought together two companies, a private company and a public company. The public company was essentially having a lot of issues. Private company had a lot of products. And it took me about a year and a half of negotiation with the private company to get them to sell because they were worried about having this incredibly high valuation. They said, we're diluting ourselves too much. We can't do that. And after the final pitch, and I worked over and over again with them on this, is that forget about dilution, forget about your percent ownership. What you care about is the fact that you own something at $1 a share. And then after we did this merger, that dollar turned into $5 a share. So as much of kicking and screaming they did at the start, the whole company as a whole revalued and went up 5x. Nobody started kicking and screaming. In fact, they were running for the exit, trying to at least get lots of money out of it at that point. But the bottom line is it's not about dilution. It's about building value. And if the VC that you bring in can help you get to where you want to go, that's intangible at the start and very tangible later on. So my feeling is early on is when you want to bring these people in, and they're different expertise, right? So you've got early stage VCs that want to do seed, but mostly Series A and Series B. They're good at the start. They're not so good to help you when you want to go public. But then there are great VCs that are looking at the middle and beyond. So we recently did a financing. In this case, I was an investor, investing Oppenheimer's money in a company, and we brought in, it's for a diagnostic company, and our fear was all about reimbursement. Well, we convinced Blue Cross to come in as a VC. They have a VC arm, and I can't tell you how helpful they've been, really guiding us to how we're going to get this thing reimbursed. And since they've come in, they've rolled up their sleeves and worked hard. So it's been very valuable.
Listen, I've been in situations where, so I typically get involved when, they're like 12 months away from an IPO, let's say a company, right? I've seen multiple situations where people are willing to go do a down round to get the right cap table before they go public. So I think the investors base that you have in your company is incredibly important, not just for the expertise, but also for the perception to the public markets, right, on how they should view this company.
So if you want to talk down rounds, I do have another slide from the investor survey. If you want to show that. 38, it's going back, so let's see if I can figure this thing out. I think it's the back button.
You got it.
38.
Yep, you got that.
So we actually asked a bunch of VCs what they expect to see in the valuations going forward. Remember, this is June now, and the market's starting to come back a little bit. End of the day, not so committal, but what it does show you is most people are expecting either flat to, excuse me, are you seeing down rounds? So basically people saying over 50% of the time they're expecting down rounds, so, or thereabouts. Some up rounds, but not a lot. So that's what the expectation is on the VC side right now, is to push these things down. You know what? That's healthy. Because again, yes, you're giving away a little bit more stock, but if you're too high, look at where all the IPOs are going now. They're going down. And that's because they were mispriced to begin with.
Yeah, there is a valuation ceiling that we have noticed more this year versus actually last year, I want to say. If you're a private company, let's say pre-money, IPO, close to 800 million, a billion, I think that's kind of the sweet spot we would like to take them public with, right? If you're a private company, let's say upwards of 1.5 billion or so, it's incredibly difficult right now to think about going public. Most of these clients that I'm working with have pushed out their IPO plans to later 2025 or even 2026. And if they are in the market right now to raise private capital, it's almost always a down round discussion at this point.
And I can maybe help everybody in the crowd understand a little bit more about some valuations on the CDMO space. So I was extremely fortunate. My first ever investment was a company called Brammer Bio, which I don't know if anybody knows in the audience. I think a few of you do. A friend of ours said, oh, we're going to start the cell therapy company in 2014, and we're going to go and take on Lonza. And I was like, yeah, that sounds like a great investment. Completely thought I was going to throw my money away. And just 3.5 years later, he sold the business to Thermo Fisher for $1.7 billion. That was my first ever private investment. I was very, very fortunate. So what is your value of your business today? All right, I'm sure that all of you, if you're associated with ownership and you're a senior management and you're maybe looking at a dividend or a share of the exit of your business. So let me give you a little bit of guidance on what we've seen in the market. So if you go back to 2006, 2005, and your business is in DP, maybe you're in a single layer CNS, so your basic central nervous system, pain medicine, CDMO, your business was only valued at somewhere between 3 to 4 times earnings. Pretty miserable, right? Well, that's nearly 20 years ago. You could have sold that business in 2021 in Q4 for 18 times. In fact, we saw that experience with a large API company that acquired a DP company and rolled it in. That now has got back down to about 9x. So just in the space of 2 years, the value of your business is halved in 24 months. But really, what you want to think about is it was valued at about 12x in 2018, and it's actually now just down about 2 clicks to, let's say, 9x to 10x. Almost every PE company, and there's many of them walking around this show today looking for investments, is not going to give you more than single-digit multiple on your EBITDA. And that's a true net EBITDA. So it's a little horrific, right? So that's the reason why there's hardly any businesses to buy right now, is because owners don't want to sell. We were also fortunate to sell a microbiome company at 41x just a few years ago, right in the middle of the COVID crisis. Does anybody know if there's any microbiome companies still around? The answer is no, there isn't. So that's about timing, and obviously timing from the investment and timing for the exit. So API, does anybody have any idea today what a non-cyto, non-high potent API or intermediates manufacturer is selling for today in Q3 2024? Anybody have any ideas on the multiple? Any clues? Non-cyto or non-high potency, non-radio pharma, of course. Let's take the sexy businesses away and let's just get bog standard fluorine, bromine, hydrogenation. What's that going for? It's going for between 12 to 14 times, which is a drop of about 6 clicks from the peak of the market and the last time a large sale was made at the end of the 2021. And that's the business that we're here today. This is the business for chem outsourcing. The core of this business has been built on chemical synthesis, right? So when you're looking at valuations, when is the right timing? And is there a secret sauce that increases your multiple? Well, we've actually talked about two technologies today on the panel, and obviously if you have a high potent or you have cytotoxic, you can pretty much add on another 4 clicks there to the multiple. But radiopharma compounds, ADC compounds, and anything that is complex chemistry will give you an additional 2 to 4 times on your EBITDA. So if you're going to build a business and you've got a $10 million EBITDA and you want to sell that for 12x over 16x, it's a pretty big difference. Are you concurring or disagreeing with that observation, guys?
Go where it's hot. I mean, that's what it's saying, yeah. That was one of the things we talked about this morning, as well as radiopharma is hot. Honestly, having clients in the inflammation space right now is pretty good as well, because that looks like it's going to maintain investment, and the quality of your earnings should be higher. Yeah. Can't disagree.
The only thing I would add is what is hot right now might not be hot down the line. If you are fortunate enough to sell your company and the hottest, and the space is hot, go for it. Don't wait. It moves pretty quickly.
Old Wall Street saying that pigs get fat, hogs get slaughtered. Don't wait too long.
That's a great line. So I'm sure that there's maybe a couple of questions that we have. I know that we just have a few minutes left before we wrap up. If anybody has any questions, we've got two extremely, I think, experienced and competent guys here on the panel with regards to the top tier in banking and obviously mergers and acquisition, and myself. Hopefully I can cover anything on brand marketing or research. Any questions that you might have from the audience? Wayne.
I have a question. In politics, there is a lot of discussion about price control and inflation reduction, similar kinds of mechanisms to, in many people's perspective, even the playing field on the price of innovative drugs in the U.S. So ultimately, it seems that will cap or erode potential earnings. And how do you, as a competitor, something distant in the future, not to put it out right now, not being a period for it, how do you, good question.
As an investor, I always worry, period. That's what we do. So the question was, given basically the ugly emergence of potential price controls because of the elections, we have price controls being talked about by one of the candidates almost on a daily basis without lack of economic experience, unfortunately. So here's the skinny on price controls. Number one is they're not likely to go through in full effect. However, there's something that probably none of you have heard about, and that's that there are 4 states in the U.S. now that have started these price programs, and only one of them at this point, many have done, 4 of them have the ability to slam down price. One of them has actually acted, the state of Colorado. Okay, imagine this. Not the biggest drug that they went after an Amgen drug. For those of you that know what Amgen did, they started to move out of the state of Colorado. So that's going to go to the Supreme Court. We'll see. I mean, that's horrific. If it winds up being piecemeal, because what happens is they'll set the price, that triggers Medicare pricing and Medicaid pricing to go down, and then everyone else follows suit. That may come to a head far before we have any overall price controls. So that's number one. On the other side of it, do we need to harmonize prices with Europe and other countries? Yes, it's unfair. And at some point, the pharma companies are going to need to stand up and say, all right, we're rationing to everybody else, it's not going to pay us. What does that do to their stock price? It goes down, period. I'm focused more, not on pharma, I'm focused on the biotech space. And let me ask you this. If I'm a preclinical company or I'm in phase 2 or phase 3, and somebody wants to limit my price that I launched with by 20%, I don't have a drug now, but I get approved. Am I a good investment? Is my stock going to go up if I get an approval and actually sell $1 billion versus $1.8 billion? Yeah, it just won't go up as high, but there's still an investment to be made and still money to be made. So I think it's less important for the small companies and for the pharma companies. It also means that pharma will probably need to buy more small companies to make up for the fact that their top line needs to be expanded more. I don't think we're going to see widespread price controls. I do think we'll see targeted price controls. So, look, the GLPs, one thing that wasn't mentioned on the panel before, it's a total mess right now in that area. You can go out to a compounder and get a GLP for 1/4 of the price. Now, the FTC hasn't looked at this. The FDA hasn't looked at this because there's a shortage. Although, arguably, the shortage is almost gone, by the way, because any of us can go into a pharmacy now and not have a wait. So the natural curb on that market is not necessarily production right now. It's the fact that these things are brutally expensive and they're not covered by healthcare programs. So the bottom line is those are the areas, the ones that are coming out. We have the IRA now, and again, I think the IRA gets changed. I'm going to throw all these out there. I'm sorry to throw so many things out there so quickly. But right now, small molecules have a disfavor to larger molecules, to biologics. I don't think that continues in 5 years from now. I think basically the government dictating medical care based on lobbying, that doesn't work, and that's going to get fixed finally. The other side, though, we now have 20 drugs that have price curbs, potentially. They haven't started yet, but they're going to come in. 10 were announced last year, 10 are announced this year. I think the price controls, I'm forgetting the date, I've got it in my talk here someplace, but.
Branded or generic?
No, it's single source. That means these are branded. Generic drugs don't have to worry about anything. You know,
Well, you've got to, and I'm sure that this is a slightly bigger observation from yours, Wayne, is that has anybody traveled and had a basic procedure or gone into a hospital somewhere overseas? I'm sure all of you have. So I had an interesting experience this year. My girlfriend had a kidney stone, which, as I told, was very painful. And we walked 100 yards to actually I drove, but went to the hospital. It was $23,000 for 4 hours. $23,000, 4 hours. So I went down the list, and it's all paid by a large Korean conglomerate who she works for, but nevertheless, I was like, that's amazing. $23,000 for 4 hours. I sat in the emergency room. So I just came back from Australia. Guess what I got on the 10th day of my trip? A kidney stone. Oof, that wasn't a bag of fun. I got a $400 bill that was all covered by my insurance. Thank you very much. Blue Cross. And I said to myself, well, wait a minute, I'm in Australia. I was in Canberra, which is their capital. Hospitals were totally fine. Actually, there was no one in there. I went in. I had 3 doses of fentanyl, which I actually didn't even think you could take, but that's what it took to get rid of the pain. And I was out in, an hour and a half. I came back, I got a bill. I looked at the bill. The insurance company sent me a letter saying, no, don't worry about it, we'll take care of it. $23,000 later, my girlfriend's boss says, blimey, that's what happened? Did you have a drug overdose? That was the question. So how bad is that problem, right? So we're talking about drug prices, but there's a much bigger problem there right in front of us that I think everybody in the crowd,
unsolvable, though.
That is horrendous.
Yeah.
I'm from a healthcare system that you get diagnosed with being pregnant in 9.5 months. I mean, it's if you want to get treatment in the UK, keep your fingers crossed. But we're in the best country in the world for healthcare. But the cost of it is horrendous, absolutely horrendous. So the development of the compounds, Wayne, that we're working on right now, you can get 2 years, and I don't know if any of you have gone through cancer treatment, but you can get 2 years of oral chemo, Mekinist and Teflanar. For 2 years, you can get that for about $290,000 in the United States. It's stage 4 cancer, and you can survive it. I'm here to prove it. They don't have that in the United Kingdom or anywhere outside of Switzerland. You can't take it, so you're dead. So the question is really, what are we going to put our money into? Are we going to have a wider quality of life for the average population, or are we going to work on the rare diseases and the ultra-rare diseases that we're going to be able to cure, sickle cell anemia and various other compounds that we seem to be very close to solving, gene mutations. So it's a bigger challenge. That's personal experiences from 2024. Guys, you're a little bit more up there on the finance side here with regards to biotech investments, but you can't invest in an organization that doesn't make money forever. It just doesn't work, right? It doesn't work.
One of the major problems that was just brought up, first of all, the hospital problem I don't think will get solved, and it's a political reason, not another reason. Hospitals, again, we talked about this morning, hospitals are the #1 employers in most jurisdictions. They donate to our House of Representatives like crazy. They're 60 to 65% of our healthcare dollar. Totally untransparent. I can just tell you, my wife was in the hospital recently. They came in with a pill. I looked at it, I said, oh, that's an acetaminophen. Take it away. And they said, why? Don't you want her to have pain medication? And I pulled out the bottle of acetaminophen, then I went and I looked, it was $80 a pill. For my little generic, that was probably about 12 cents. So totally untransparent, that's #1. #2 is, in addition, saving the healthcare system. If we save 10% of hospital care, it's a lot more than 10% of drug spend, a heck of a lot more. So the problem is, again, and we'll go through this again, politically, all of our healthcare system was set up, and our insurance system was set up years ago when drugs weren't major. It was basically set up to get people to come and take jobs when there was a labor shortage. Hospitals were where it was at. That's where you got most of your care, with physicians and hospitals. You didn't get drug care. So they set up the programs such that they didn't really do much. So as a person on the street, we feel the pain of the pharmaceuticals more than anything else, unless you've got really good healthcare coverage. I don't know about that. When I used to work in the hedge fund business for a large healthcare hedge fund. Best healthcare I've ever had. He just gave us a credit card and said, you do whatever you want. You want a nose job, you want therapy, and he encouraged therapy. Whatever you want, just go get, I'll pay for it. Now we have to worry. I go in for a colonoscopy, they actually find something, and it's like, oh, we found something. We're not covering your colonoscopy, give us 10 grand. So, and it's like, well, had I known that, I would have shopped around, right? So that's the issue, is that it's an inefficient system, and that's where I think we ultimately can in the near term work, as long as we have a reasonable government. Problem is, market forces aren't allowed to come to play in this area. And if they did, we'd be better off. And without that, we need the government to step in. And again, that's hard.
It's gonna hurt, Wayne, the ultra and the rare disease market. It's pretty much going to completely cripple it.
Yeah.
That's my feeling. I mean, I follow that space really closely, especially for my own investments. There's going to be no more rare and ultra rare disease investments. Acceleron, these organizations, I mean, they're just not going to exist anymore. I mean, that business was sold for, was it 38 billion, 40 billion? Yeah. AstraZeneca would have never, ever paid a penny for that if there was. I mean, you just can't do it. There's some amazing, amazing work. I managed to meet some of the research scientists from Acceleron many years ago, and I was like, wow, you dedicated your entire career to something that may not come about, and it did come about, and you kind of get a little emotional talking to them. And this is the world that we live in. This is the science. This is why we're here at this show. This is why we have our careers. It's not to make money, is it? Let's call it what it is. It's because we love science and because we want to see new drugs coming out, and we want to support it financially from our perspective, and you guys want to manufacture the drugs, and you feel good about what you're doing. There's a lot of other professions you can make money in, but we actually feel really good about the work that we do. Does anybody have any final questions? I know we probably want to get out of here. Maybe people want a glass of wine, but I'm happy to take another question before we wrap up. We're good. Well, again, let's thank Mark and his team at Chem Outsourcing. This wouldn't happen without his commitment. It's tough to keep a small show going over the years, right, Mark? And really appreciate you inviting the three of us here today to talk. Thank you, Mark.
And
Thank
for
you.
anybody who wants the slides, there's a lot more behind it. Just go to the website, log in, you can download them.
Feel free to catch us on LinkedIn. It's Nigel Walker, of course, and don't be scared about the Mad Max journey that we're doing right now across Australia. I am actually in the United States, not in Australia. There's a few people say, how did I get here? No, that you can actually use a video camera and shoot it in advance, just so you know.